Imagine a world where the very institution tasked with minting your nation's coins suddenly declares it can no longer price one of the most fundamental metals in human history, silver. Picture the chaos unfolding in real time. Vaults echoing empty, investors scrambling in panic, and the global economy teetering on the brink of a catastrophic default where physical silver vanishes from reach, not because it's worthless, but because it's become priceless beyond measure. This isn't a dystopian fiction. It's the stark reality that erupted on January 15, 2026, when the United States Mint slammed the doors on silver sales, admitting in their own words that the surging volatility has rendered accurate pricing impossible. But what if this suspension isn't just a temporary glitch? What if it's the first domino in a full-blown physical default, where the paper promises of Wall Street collide with the unyielding truth of scarcity, potentially unraveling trillions in wealth and reshaping the financial landscape forever? The answers lie deeper in this story, buried in layers of manipulation, demand explosions, and hidden forces that could either save us or seal our fate. Stay with me, because by the end, you'll see why ignoring this could cost you everything. To grasp the gravity of this moment, we need to step back just a few hours into the heart of today's trading frenzy. The silver market, already a powder keg after weeks of relentless climbs toward unprecedented highs, ignited in a spectacle of volatility that left seasoned traders breathless. Early in the session, silver futures danced near the $93 mark, a level that whispered promises of prosperity to those betting on its ascent amid global industrial hunger and inflationary fears. Yet, in a blink, the price plummeted nearly 8%, scraping the $86 floor before clawing back some ground. This wasn't a gentle correction, it was a violent shakeout, the kind that triggers automated sell-offs and shatters confidence. Whispers from the trading floors pointed to a confluence of factors. Delayed tariffs on key imports that momentarily eased supply concerns, coupled with algorithmic trading amplifying the drop like a digital avalanche. But beneath the surface, something more sinister brewed. Dealers across the nation reported premiums on physical silver exploding, with American Silver Eagles, those iconic coins stamped with Liberty herself, fetching street prices well over $100 per ounce, even as the spot price dipped. This disconnect wasn't accidental. It was a symptom of a market fracturing at its core, where the digital ticker tape no longer reflected the tangible world of metal in hand. Now, enter the United States Mint, an entity as old as the Republic itself, founded in 1792 to forge the coins that underpin American commerce. On this fateful Thursday, they issued a statement that sent shockwaves through the precious metals community. Sales of over 37 numismatic silver products, including the beloved American Silver Eagle, were immediately suspended. The reasoning, a need to recalibrate pricing amid surging demand. But let's decode that bureaucratic veil. In plain terms, the Mint confessed they couldn't keep up with the whirlwind of price swings and insatiable buyer appetite. Imagine the scene inside their fortified facilities. Analysts poring over spreadsheets, suppliers balking at quotes, and executives realizing that the cost of silver blanks, the raw material they stamp into coins, had decoupled from the futures market in a way that defied logic. This isn't mere administrative housekeeping, it's an admission from the government's own coin maker that the system is breaking. For context, the Mint operates on a cost-plus model, buying silver at market rates plus a premium, then selling at a modest markup. When they halt sales, it's because the input costs have skyrocketed beyond viability, or worse, because the physical supply chain is choking under pressure. Reports from insiders suggest that even at $86 spot, suppliers were demanding premiums that pushed the effective price north of $120, rendering the Mint's operations untenable. As the news rippled out, the reaction was swift and visceral. Social media platforms lit up with frantic posts from investors, some hailing it as a bullish signal of impending shortages, others decrying it as evidence of systemic failure. One trader on a popular forum captured the sentiment perfectly. If the Mint can't price silver, how the hell are we supposed to trust the markets? This suspension didn't occur in a vacuum. It capped a week of escalating tensions in the commodities arena, where silver's role as both an industrial powerhouse, essential for solar panels, electronics, and medical devices, and a safe haven asset collided with geopolitical headwinds. China's export restrictions on rare earths and metals had already tightened global supplies, while the U.S. push for domestic manufacturing amplified demand. Add to that the specter of inflation, with central banks worldwide grappling to tame it without tipping into recession, and silver emerged as a barometer of economic health. But today's drop? It felt engineered, a deliberate push to flush out weak hands before options expiry loomed, where billions in bets hung in the balance. The banks, those shadowy architects of leverage, know the stops. They see the pain points. By driving the price down, they aim to expire calls worthless, saving their skins at the expense of retail dreams. Yet, as we peel back the layers, a more alarming pattern emerges. This isn't the first time the Mint has paused sales. Precedents stretch back to the 2008 financial crisis and the 2020 pandemic frenzy, but never with such explicit acknowledgement of pricing paralysis. In those earlier instances, halts were blamed on production bottlenecks or coin blank shortages, but today's rationale points to a deeper malaise. The spot price, that supposed oracle of value, has lost its grip on reality. Dealers like Apimex and JM Bullion, giants in the physical trade, compounded the crisis by imposing draconian measures of their own. Minimum order requirements skyrocketed to $10,000 for sellbacks, effectively barring the average saver from liquidating holdings. Presale items were restricted, and premiums ballooned to 40% over spot, turning a simple purchase into a luxury affair. Why? Because the vaults are draining faster than they can restock. Industrial behemoths, think Samsung for batteries, Tesla for EVs, are vacuuming up supply, viewing the dip as a fire sale. Meanwhile, retail panic buying, fueled by headlines of economic uncertainty, has overwhelmed logistics. Trucks laden with bars sit idle at borders, refineries operate at capacity, and the physical metal flows eastward to Asia, where Shanghai's exchange holds firm at premiums that mock the Western plunge. This divergence between paper and physical isn't just academic, it's a harbinger of potential default. A physical default occurs when the exchanges, like COMEX in New York, can no longer deliver the metal promised in contracts. Historically, these markets have settled in cash, but with delivery demand surging, reports indicate a 300% spike in stand-for-delivery requests this month, the system strains. If holders insist on physical bars rather than fiat equivalents, the warehouses could empty, triggering a cascade of failures. We've seen echoes in nickel markets 2 years ago, where shorts squeezed prices into oblivion, or in oil during the pandemic when futures went negative. But silver, it's different. With above-ground stocks estimated at a mere 1.5 billion ounces against annual demand nearing 1.2 billion, the math screams imbalance. Mining output lags, recycling can't bridge the gap, and strategic hoarding by nations like India and Russia exacerbates the squeeze. The mint suspension amplifies this. If even the sovereign producer can't secure blanks at viable prices, how can the exchanges fulfill obligations? Whispers from whistleblowers suggest COMEX inventories are at multi-decade lows, with much of the reported stock tied up in ineligible forms or already spoken for by long-term contracts. As we delve deeper, the human element comes into sharp focus. Consider the everyday investor, a middle-class family in Ohio or a pensioner in Manchester, who turn to silver as a hedge against declining purchasing power. Many watch their holdings appreciate, only to face a market where selling now involves navigating wide premiums, limited availability, or delayed fulfillment rather than clean, transparent pricing. Stories continue to surface across online investor communities. One individual described driving hours to a local coin shop, only to find the doors closed with a notice stating, "No silver available." Another shared screenshots of online orders canceled mid-process, citing unprecedented demand. This is no longer abstract market theory. It reflects real financial stress for real people. While headline prices may suggest accessibility, on-the-ground pricing tells a different story. Silver eagles that once carried modest premiums are now listed at significantly higher levels, reflecting tight supply conditions rather than speculative excess. Dealers, facing their own sourcing constraints, are increasingly forced to ration inventory, often prioritizing larger buyers simply to maintain operational stability. The result is a divided market. One tier with direct access to supply and another navigating uncertainty while holding weakening fiat currency. This is where the narrative shifts and becomes more complex. What if the suspension of sales is not merely a breakdown, but a signal of deeper structural stress? Historically, the U.S. Mint operates within broader fiscal and monetary frameworks tied to Treasury policy. The timing of this halt aligns with wider economic adjustments, including recent trade policy signals that briefly ease pressure on industrial metals markets. Some analysts suggest these overlapping developments reflect competing priorities, stabilizing inflation expectations, while managing strategic resource availability. In this light, the phrase, "we can't price it," may indicate caution rather than collapse, highlighting the difficulty of maintaining orderly distribution amid extreme volatility. If authorities eventually move to stabilize supply through strategic measures, it could reshape pricing dynamics and challenge assumptions about free market allocation. The question then becomes less about scarcity alone and more about control and coordination in a strained system. As the situation evolves, concerns about a broader physical shortfall continue to grow. International markets add further pressure. Premiums in Asian exchanges remain elevated, encouraging metal to flow eastward where industrial demand is expanding rapidly. Manufacturing sectors tied to renewable energy, electronics, and infrastructure continue to absorb supply aggressively, viewing recent price pullbacks as opportunities rather than warnings. Meanwhile, refiners report extended lead times and mined output faces competing bids across global markets. Exchange inventories are being closely watched, with analysts noting historically tight conditions that amplify volatility during periods of stress. While comparisons to past squeezes circulate, today's environment is shaped by faster information flow and deeper global interconnection, magnifying both risk and reaction speed. The implications extend beyond trading desks. Silver plays a critical role in modern industry, from electronics and medical equipment to renewable energy systems. Persistent supply tightness could raise costs, delay projects, and ripple through broader economic activity. Yet this moment also exposes long-term vulnerabilities: reliance on just-in-time supply chains, underinvestment in mining, and growing industrial dependence on finite resources. Whether innovation, recycling advances, or policy adjustments can ease these pressures remains uncertain. What is clear is that the current disruption has forced a re-evaluation of silver's role, not merely as an investment asset, but as a foundational material underpinning modern life. The suspension of sales has become a signal, revealing how fragile the balance truly is when demand accelerates faster than supply can respond. As the dust settles on this tumultuous day, we're left with a profound reflection. The U.S. Mint's "we can't price it" crisis peels back the curtain on a financial theater, where illusions of abundance clash with harsh realities. For the investor, it's a mandate to hold physical, to distrust screens, and to prepare for volatility's next act. For society, it's a mirror to our dependencies, on distant minds, on geopolitical whims, on the thin veil of stability. This isn't merely a market blip, it's a pivotal moment where we choose: cling to outdated systems or forge resilient paths. You've journeyed through the chaos, the twists, the impending shadows, and emerged with eyes wide open. In a world of uncertainties, knowledge like this isn't just power, it's armor. Remember, the next chapter unfolds tomorrow. Stay vigilant, for the metals that built empires may yet redefine ours.